Welcome back to the channel, guys. I just wanted to do a video around LEAPS. A lot of people have heard the terminologies and don't really quite know exactly what a LEAP is. So I thought I'd outline the LEAPS and explain a bit around what LEAPS actually means. So what exactly are LEAPS? They're long-term equity anticipation securities. Bit of a mouthful. So LEAPS are not a complex new type of investment. Okay, they're simply a standard stock option, and this could apply to both calls and puts with a much longer time frame. To be classified as a LEAPS, an option must have an expiration date more than 1 year from its date of issue. And that's, in a nutshell, simply what it is. This extended time horizon is key, though. It allows investors to take a long-term bullish with calls or bearish with puts stance on a stock, similar to owning the stock itself, but without the high upfront costs. And we'll talk about why LEAPS could be beneficial from that perspective. It gives the investment strategy time to play out, riding through short-term market fluctuations. So, how one option controls 100 shares. So think of buying a LEAPS call option as putting down a deposit to lock in a future purchase price for a stock. You aren't buying the shares today, but you're buying the right to purchase them later on at a fixed price. So let's draw this out. So the contract, one options contract always represents the right to buy or sell 100 shares of the underlying stock. The strike price, that's $500 in this case. This is the locked-in price per share you'll have the right to pay if you decide to buy the stock. It doesn't change. The premium, so this is the total upfront cost to purchase the contract, the right. It's the only money you risk. So a $15 premium per share times 100 shares. The expiration. So for LEAPS, as I said, this is the date far into the future, e.g. this could be January 2027, giving your investment thesis time to play out and unfold. So by paying the $5,000 premium, you're gaining the right, but not the obligation to buy 100 shares of MegaCorp, let's say at $500 per share, anytime before the distinct expiration date. This gives you leverage exposure to the stock's potential gains. So how would this work out compared to just going and buying the stock? Why would you do this? The core idea is to use LEAPS or call options to control 100 shares of a stock that you're bullish on. This example shows how you can gain the same exposure to MegaCorp's potential growth for just 10% of the cost of buying the shares outright, freeing up kind of significant capital. Because obviously before we would have, to buy 100 shares, it would have cost us 50,000 at a strike of 500, but we're able to control 100 shares for 5,000. So I'm able to get it a lot cheaper than having to go in and buy it direct. So capital outlay, so stock versus LEAPS. A LEAPS option requires significantly less capital to control the same number of shares, and this frees up capital, obviously, for other investments, reducing that concentrated risk within a portfolio. So the power of the leverage, let's take an example, a 20% stock gain. So let's assume MegaCorp stock rises from $500 to $600. The LEAPS options, which magnifies the gain, show a much higher percentage return compared to the capital that we originally invested. Okay, so this is the power that we can do with the LEAPS. So just to illustrate this as in a chart format here, the chart showing the potential outcomes for the LEAPS options at its expiry date based on the price of MegaCorp stock. So the maximum loss is limited to the premium that we paid, which was that $5,000, while the profit potential is theoretically exponential, right? Whatever the maximum MegaCorp price can rise above that. So you're mitigating your risk, but you're uncapping that potential upside that you can potentially gain. How does the strategy work in kind of a workflow perspective? So you've obviously got to have a bullish outlook if it's a call. Identify a stock that you think will increase in value over the next couple of years. Select a LEAPS call, so choose an option with an expiry date far into the future, but you've still got to pick a rational strike price, okay? Then you purchase the option, pay the premium to buy the contract, establish your position with less capital, and then you, in this kind of monitor and wait game, track the stock's performance. The long time horizon allows you to ride out that short-term volatility, and then you sell the options contract, ideally before expiration, realizing your profit or loss. So it's a really simple strategy. So what we need to, the kind of key takeaway here is obviously understanding the fact that LEAPS are just long-term options contracts. Okay, there is nothing complex around LEAPS. So if you hear that terminology, I just wanted to do a very quick video on explaining what LEAPS are and the dynamics of LEAPS. Let me know in the comments whether this was useful, guys. It was a very quick one. I look forward to catching you on the next one. Just for a heads up for those that are waiting on the giveaway, I've spoken to Income Shares today and they're looking to post these out over the next couple of weeks. So look out for those that have contributed to the giveaway. Those that missed out this time, don't worry, we will be doing more of these types of things in the future. I'm not sure what the formats will be, whether it'll be the same format or we'll change the format, but we'll make sure that we do more in the future. We'll obviously replay the feedback as well back to the community in terms of what's been shared with us. We'll take that back and do a video. I might do another interview with Outlay and we'll figure out how best to relay what you guys have raised and shared with us. I thought it'd be quite fun actually for those of you that watched the end, branding it as the 100% Club. So put in the comments if you make it to the 100% Club, and it'll be a bit of a running theme that we do on the videos now. So thanks for watching, guys. Remember that nothing here is investment advice. I will catch you on the next one.